Stop paying too much in tax. In this episode of Faith and Finance, I'm going to break down how income tax works and how it actually applies to you and give you calculations and show you so you understand. Because by understanding how you get taxed, it's going to empower you and open up the doors to a lot of tax saving strategies, which I plan to post on in the future, inshallah. So let's explain how income tax works here in Australia. To help explain this concept further, I've drawn up a bit of a diagram here, and please bear with the horrible handwriting. So we're going to start with your assessable income, and that's a combination of all your income sources coming together. So an example can be your salary, rental income on an investment property, and even dividends from shares. And there's more to this, such as even capital gains, etc. So you get all your assessable income together, minus your deductions. And deductions are basically expenses that you incur relating to generating assessable income. So that can be, if you have an investment property, then you can deduct the maintenance fees and expenses associated with that investment property, even relevant work-related expenses as well. So assessable income minus your deductions equals your taxable income, all right? From that, once you have your taxable income, you times it by your marginal tax rate. So that's those brackets which we're going to be going through. An example can be that 30% bracket. Once you have that, from there, you then also, once you have that dollar amount, you then times it by Medicare levy, which is standard, say 2%, for example, and that's going to be your Medicare levy. From there, you have your tax offset. So you will minus any tax offsets that you have. So for example, if you're doing like a spouse contribution, you'll into your wife's superannuation account, you'll get a tax offset associated with that. That will equal your net tax payable. So of course you deduct that from all your assessable income sources, and that's what you're left with in your pocket. So the ATO get their clip at the end of the day. Now that's all great, but let's actually calculate a dollar example in a real world scenario. So for example here, we are using an assessable income of $100,000, again from all the different income sources coming together, minus the deductions, and we've used $5,000 as an example. Let's say you donate charity to a registered charity and you get your tax receipt for that, so that's $5,000. So 100,000 minus 5,000 equals your taxable income, which would be $95,000 in this scenario. From there, this taxable income is then applied to the marginal tax rate. So we can see here that it's all in brackets. So the first $0 to $18,200 that you earn is actually completely tax-free. So for low-income individuals, their individual marginal tax rate would be 0, which is fantastic. And then it progressively gets more and more the more taxable income that you have. So from 18,201 to 45,000, 16%, and then 30%, 37%, and then all the way up to 45%, which is very expensive. So from there, once those brackets are applied, we get the base income tax of $19,288, okay? From there, we then apply Medicare levy. We're assuming 2% in this scenario here, so 1,900, minus any tax offsets that you may have. This will equal your net tax payable. So adding up the Medicare levy plus the base income tax, so $21,188. So from that, you minus 100,000 minus the net tax payable, and that's going to be your after-tax take-home pay that you get. So as far as what tax bracket they're in that 30% bracket, because that's they didn't exceed that $135,000 in taxable income amount, and the effective tax rate is actually 22.3% if you divide the net tax payable by the take-home after-tax pay. So an example as well that I get questioned on a lot too. So for example, when you earn income from work and you get your salary getting paid in, and you'll see PAYG, pay-as-you-go tax. And so it goes your gross income minus that PAYG equals the actual take-home pay that you're getting. So a lot of the time there's some confusion around that PAYG, and what that basically is, it's your employer assuming what tax bracket you're going to be in and basically guesstimating how much tax you're going to have to pay, and then they send that to the ATO, okay? So let's say in this scenario, your actual net tax payable is supposed to be $21,188. Let's say that your employer over the course of the financial year sent $22,188, so $1,000 more than they should have. So when you do your tax return, it all gets rectified. You get that $1,000 in extra tax that you paid, you get that returned back to you, okay? So don't stress too much if the PAYG amounts are high or low, whatever. It all gets rectified come tax return time. And then the opposite side is true. If your employer didn't deduct enough PAYG tax, let's say if they deducted $20,188, well, you actually owe the ATO $1,000 in tax in that scenario too. So hopefully that explains a common question that I get. So that's it. I hope you were able to get value out of that. If you do have any other questions, definitely reach out and let's crack into the next episodes in this series of Faith and Finance where, inshallah, we can break down some tax saving strategies.